Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
Oil production is very tricky it's a lot stickier, and you can throttle back some of it, but you can't just shut it down for the most part because it hurts the wells, whether it's you have to build up pressure. There's a whole thing. There's two different ways of doing it. You can walk out, send an engineer to the field, they turn the screw, it turns it from 10 barrels a day to 3. But below 3, it's going to be a problem because you have to cap it. There's a lot of issues with that. So what happened was we started filling up production. So again, back to the beer analogy, our beer just started to get close to the top, but the tap's still running. And, we had to figure out a way to jam that tap shut really quick. And it wasn't a sexy way of doing it. It was really just, like I said, oil went negative. We filled up oil storage pretty much almost entirely here in the United States. All of these companies cut their CapEx for the future by 50, 60%.
All right, hello everyone. 1 year ago, we brought you one of our OG emergency pods, crude oil going negative, what the WTF. And that's right when May crude oil futures went down negative 40 something for the first time ever. Essentially saying you get paid to take that oil. So a year later, we wanted to catch back up with what's been going on in the oil patch, so to speak. With one of our favorite energy traders that we brought on a year ago to talk about what's gone on there and his what he's doing with his program, Cayler Capital. So we've got Brent Belote with us from Wyoming. Welcome, Brent.
Thanks, Jeff.
So we're just talking online. I always find your travels, since I knew you right when you left New York. So I always find these travels. So you started in New York, ended up in California, and now live in Wyoming. What's that all been about?
Yeah, we kind of fell in love with Wyoming. We did a cross-country road trip when we left New York, thinking my wife and I, both native Californians, were going to live in California for the rest of our lives. And we drove cross-country, stopped in Jackson, supposed to be 3 days, stayed 8, got to California, started looking at homes to rent, and just turned around and came back, and we haven't left. So it's been really good here. Kids love it. Winter's a little tough, but luckily we have family still in California that we can escape to if it gets too cold. So it's been a huge win. Good community, great wildlife, and COVID has made this place go pretty bonkers. And luckily we were here before then.
I imagine, is the airport filled up with all the jets and people using their second home?
We've seen a huge influx. Not to make this a real estate podcast, but I think our real estate prices have doubled in the last year. And there's just no inventory. And people think of Wyoming and they think of a huge, vast expanse of open land, and that is the case. But in Teton County, 97% of the county is either national forest, refuge, like animal protection refuges, or a national park. So it's kind of an interesting dynamic where you have all this space, but there's nowhere to build. So
and there's restrictions. You can't throw up a 60-story condo building, right?
No, the restrictions in town I think are like 30 feet high. So 30 feet high is the max. So
my brother's a realtor in Boulder, and it's the same thing. He's like, you think Colorado, but there's literally no more places to build in Boulder because they've carved out green space and this park and that park. So he's like, it doesn't matter if the economy crashes. People want a house in Boulder. They're going to wait for someone to die or divorce or something happen and jump in.
Yeah, it's true. It's a weird dynamic of no space and plenty of space. But
and then you guys got an Airstream during the pandemic?
Yeah, we decided to buy an RV. We initially bought it in April of last year, and kind of the thoughts were we wanted to go see our family in California and go stay with them for a while, but we didn't if we're going to quarantine, we'd rather quarantine with, family members who haven't seen our kids in a while. And it was just a really good opportunity to try to hit the road. But we weren't sure how to get the 15 hours from here to California or 15 hours to here to Southern Oregon, where my mom is. And so we bought an RV and kind of caravanned out there, and have really fallen in love with it, and being able to do it. And it's nice because the kids, you don't have to go outside to the bathroom. We don't have to get hotel rooms. We can just pull over. It's very self-sufficient, self-sustained, safe place to be. So it was.
Yeah. This is a driving one, or you're towing it?
It's a travel trailer, so it's a tow one. So we tow it in the car. Yeah.
Got it. So they can't, like, I'm almost thinking of the one I'm driving, and the kids would be like,
No.
back and making a sandwich or microwave popcorn or something. Like, no.
It's not as easy as that. But luckily, in this day and age with all the entertainment and nowadays, kids are happy to get in the car, because if we use that as their only means of watching shows and things. So.
And then you just came back from California, from one of those trips, seeing the family, and you drove through the southern route, you were telling me?
Yeah, exactly. So we did a week-long trip through the southern route, took a couple days and did Santa Fe, Taos, up through Colorado, a town called Leadville, and then Steamboat Springs, and then a kind of a shotgun drive after that. It's about 8 hours, but it took us 12 because we had a freak snowstorm, which if you're pulling something in a car and you get a kind of a blizzard where there's 30 feet and it's 2 degrees, feels like temperature, it's time to pull over. So
yeah, my buddy actually has an Airstream, and he had the Infinity SUV towing it, and he was coming down in Colorado and rolled the entire thing.
Oh Jesus, those things!
And like it went
it terrifies
sideways.
Me.
Yeah, flipped the whole thing. He has 3 kids. They're like upside down when they stopped, and he's like, "Because everyone's 2 were crying," he said, and 1 was laughing.
Wow,
and they're just like, "Is everyone okay?" They're like, "Yeah."
It's scary. Those things are scary.
Yeah, so be safe out there. And then I mentioned Taos on another pod, and some guy on Twitter told me Louis Bacon, the famous trader, bought that a few years ago, which I never knew. So
the mountain, the ski resort.
Yeah,
that's cool. I didn't know. I've never skied there.
It's a skier's mountain. Like, my wife wasn't too happy about it. Like, where's all the fun stuff? So it's just about the terrain, and that's all you get.
I get spoiled though, because I asked the local. I said, "Oh, I've never skied here. Do I need to ski?" He's like, "Where are you from?" And Jackson's like, "Just stay there."
Yeah, he's like,
okay.
"No,
I get it.
Keep going." Yeah,
all right. Let's talk energy.
Let's do Jackson this winter, and we'll do a live pod out there.
Perfect. Love it.
That'll be fun. So sorry, we could talk about skiing all day. So
I was gonna say, this is a great real estate and ski podcast.
So let's back up of what you were doing in New York, how you got started, and
sure.
all that good stuff, the background.
Yeah, so in New York, I worked for JP Morgan. I was trading gasoline, heating oil, jet fuel, WTI, and Brent. Started on the oil book, and after 8 years, switched over to products, working on refinery models. In the oil book, I was trading a lot of basis markets, working on the physical space. So really kind of got a good understanding of how oil moves out of the ground through a refinery and into, the end consumer. Started programming and kind of trying to track as much info as I could algorithmically and pulling it into different models, and built Cayler Capital pretty much, right when I left JP Morgan. Sat out for a year, had a year sit out, non-compete clause, and launched Cayler Capital. And we are a algorithmic systematic trading firm, and our program is Cayler Capital Systematic Energy Diversified. We only focus on the oil space, so no natural gas, and we trade 6 models that look at different aspects of.
I'm going to pause you there because we'll come back to Cayler. I want to dig into what was going on at JP Morgan on that desk, because huge numbers, right, in terms of dollars and barrels and everything you're doing. So, right, this wasn't a prop desk. You're not trading the bank's money per se.
We had access to the balance. So it's kind of a trick question because, with the Volcker rule, you had to be careful with outright prop trading, but we also had risk parameters that we could stay within. So I would say about 70% of the trading was client related. So clients, on the oil book, clients from producers to consumers. So we would deal with airlines. We would deal with, standard EOGs, Conchos, kind of the guys who were doing shale drilling at the time. And they would come to us and we would hedge out future production for them. We'd come up with different strategies. We would help them with, kind of structuring revolving lines of credit. So really anything. And then also we have the hedge fund clients who are more flow based, would be more opportunistic, would come in and do huge option structures or just want to buy spreads or do something like that.
And so the shale guys, that's tied in with the whole bank. So they're saying like, hey, this is a super risky loan because you might not find any oil. So I want you to hedge. And like, how did that all work?
Yeah, exactly. So, as a lot of the banks kind of have a monopoly on some of the trading flows that go on, especially JP Morgan and Morgan Stanley and Goldman Sachs, because they issue the revolvers, and the revolvers will be that you have to hold the credit, you have to hedge a certain percentage, or you have to hold it with us. So we'll give them lines of credit, and they'll have to either trade with us or come to us for certain hedging parameters, because otherwise they're going to get capital calls against us, against our credit, right? Because Goldman Sachs doesn't care what revolver we have. They want the money in their house if it needs to be mark to market. So it's an interesting dynamic to be there and learn about it. And especially when I started JP Morgan Oil Book in 2008. And when I hired, I was the 11th hire on the oil team. And we grew to 140 within, I think, 5 years. They purchased Mercuria, we purchased UBS Canada, and it was actually, people would say, I'm like, oh, that stinks. But it was really a great learning opportunity for me because we kept purchasing these physical groups because there was a big push to expand into physical oil, which in hindsight wasn't a great choice, but it was great for me because I got to learn about the physical oil, gasoline blending, how everything moves. We got to work on a project where they were doing rail from Canada down to the Gulf Coast, and then they'd throw it in tanks, blend it, and then resell it. And it was this whole project where we did a lot of hedging, and I really got to understand kind of how oil is moved around the world. And it, I say it wasn't a good move because when I left in 2016, we were in the process of divesting all of those physical assets.
Yeah, Mercuria is back a private company now, right?
Yeah, the primary reason is it's really capital intensive to do it. And if you look at a cash on cash return, it's not a very good one. Whereas like I think our derivative group was making somewhere in the 20 to 25% range, cash on cash of how much we were tying up the bank. And the physical business is usually single digits. And it makes sense if you think about it. If you charter a million barrel vessel, that could be $50 million of cash that you have to tie up on day one if oil price is 50, not including the charter costs, not including the insurance, not including the other people. So it's just kind of a murky thing. And not to mention physical oil outside of, I'd call it, first world countries, it's a little gray area with some things on how deals are made and ships get released and customs. So, not the risk you want to have at a bank per se.
Yeah.
That could be a whole podcast explaining that one sentence.
And talk to me for a second about just the size of these flows, either from those physical groups or from the hedge funds. And was it all going to exchange, or there was a lot of over-the-counter stuff as well?
We did a lot of OTC until Amaranth, and that whole kind of blow-up happened. And once that happened, pretty much there was a huge push where I think almost all of the flows had to be Clearport or ice clear for their ice block. Something had to be exchanged just because we had too much risk. And so the amount of flows that we would see from hedge funds could be anywhere from 10,000 options to 20,000 options. And on the flow of the producers, some of the producers do 300 barrels a day, which, if you think about it over the course of a year is 300,000 barrels a day, excuse me. Which where you think about it over the course of a year is just a massive amount. And they would try to do, I'd say 20 to 30% of their hedging in a 2 to 3 week window usually. And so, there's times where they did that. And we also handled one of the largest hedging programs in the world, which was Mexico. So Mexico, if you Google Maya, Pemex hedge, it's the largest one that comes out, and every year it's they come in and they're doing 5 million barrels of oil every single time they come in, which at the time was about $400 million worth of oil every time it comes. So it was a very interesting time and really a great learning experience. So
yeah. And it's crazy world to me that most people don't know about, right? Like the physical side.
Yeah, absolutely. And I was kind of naive too. Like I knew when I came out of NYU, I knew I wanted to stay in commodities, and I was kind of focused on oil. But I was open to natural gas, but I knew I wanted to stay in commodities because I love the physical aspect of it, of how it's, it's not like valuing a company where it can be different. It's, there's arbitrages that open and then they get shut, and that's how you price it. And there's different mechanisms and levers and movements, and kind of forecasting it was really fun. So it's something that
It
I really
seems like
enjoyed
there's a
trading.
lot of optionality too, right? Of like, hey, I'm wrong on the direction, but let's throw it in this storage tank. Let's keep it on this ship. Let's
Yeah, yeah.
go out
Well,
forward
I
in
mean,
time.
yeah, yeah. People always joke it's like and it's true. It's a lot easier to trade around physical assets, and I mean, and again, like part of the murky waters is some of the best physical oil product traders in the world are based out of in Chicago at BP. They
Yeah.
seem to have quite a lot of oil refining capacity, and get a lot of insight into how things are pricing and blending and what's the cash market doing. So, I will say that if you look at it, they have the info, and having the physical information is kind of what led me to Cayler Capital, because I found that was the real driver of price. It wasn't, and I saw a lot of traders that came in and would just they were looking at physical oil, and I met some that were technical, and there's no wrong way to do it. There's a million ways to skin a cat, but the ones that I found that were really, really successful had a deep, deep understanding of the physical oil market. And I'm talking, the Andy Halls of it, the guys who have come. Pierre Onderon's another good example of guys who
Yeah, I was just about
have
to
a
say
deep
Andron.
physical understanding.
And so just on that JP Morgan desk and around New York at the time, like guys coming off these energy desks, are there guys getting like $1 million bonuses, $10 million bonuses? What do those numbers look like for youngsters out there
Yeah,
listening who want to get involved?
yeah. I mean, they're big. They're big. Yeah, they're very large. So it was a good place. I mean, I think if you were there between 2005 and 2015, it was much better. And I think that was kind of the impetus. I've seen a lot of exits from banks and trade houses from guys that I knew at the time, and the primary impetus is the banks just they want you to less risk taking and more just capturing the client business that is pushed your way, and they know that they can pay people less because you don't need as talented as traders if you're just trying to have the back to back. So yeah, I mean they used to pay very well, and it was a great time to be there. But it's also just one of those things where kind of the nature of the world, margins get squeezed, people get paid less, and they want you to do
Yeah.
different jobs and different things. So
Right. In the grain side, on the physical side, it would be,
yeah, when I say back to back, I more mean that a producer comes to, they want to hedge their production. So I give them a price, they come to me. I have, kind of two different tranches built in. I have a tranche, a bid ask of what JP Morgan, the bank, is going to charge me to hold that, which is usually 10 to 15 cents a barrel. And that's just based off of, what they charge our desk. The Treasury Department at JP Morgan charges our desk for using credit. And so that would be that charge. And then also the bid ask of what I think the current liquidity as the trader is to get in and out of that. So that's how like the margin on my end would work. And then, once I execute the trade with the client, I'd go to either, the screens, and I can either do it in one tranche, or I can kind of piecemeal it, or I can look at my overall portfolio, which would house, I think each portfolio had something around the realms of 4 or 5 million trades in it. And you could look at the overall portfolio and say, okay, well, this kind of fits here, so I'll put that there, and it offsets this one. And I came into the day short, and it's oil's down, so I'll take some profit. And so there's a lot of nuances and ways to go about it that
yeah, I
that
think
made it easy.
what I'm thinking of is on some of these grain desks, right? And they have a farmer, some will just buy his whatever 5,000 bushels of corn and book it internally, warehouse that position and that risk, and then start to hedge it and trade around it. And other
Yeah.
groups will only buy it from them if they have the seller already lined up.
Yeah. Now we're the
Are there-
first. We'd buy it. We'd figure out, okay, anyone want this? Who's going to do this? And especially when you're talking about large derivative portfolios where there's, thousands and thousands of option trades and offsets, and okay, well, I'm getting long 50,000 Vega, but I already have the offset because I came in short, or I'm long, and I liked it at this price, so I'm just going to hold it. Historically, here's where here's where we start seasonally turning and seeing demand pick up. So we're just going to hold it and ride it out. So there's different ways.
How does that work when you had 150 traders? Like then that book is so complex. Like how do you know that what you're doing isn't?
Well,
like...
the books are always split up. So we ran a,
Okay.
we took the Goldman model. They had a book called LDNY, it was London, New York, and it was the London, New York crude book. And so when I was on the crude book, we combined with the US and London, and it would essentially just be a handoff 1-to-1. And then eventually we added Singapore. So it would basically be a 24-hour book that was just kind of trading. But New York was the main. I think New York trading hours had about 80-90% of the trade flow. And it would just be a massive, book. But then everyone else, then you have your oil basis traders, and that's their wheelhouse. So they have theirs. So, if someone came and wanted an oil basis trade, it goes to them. If they came and wanted a derivative trade, they'd come to us. So there was different, there's all these different silos of traders and who gets what and how it's kind of chopped up. But having a global book like that, yeah. So like 150 traders, yes. We dealt with, on the LDNY book, 6, and then on the product book, 3. So it was, it was a very, very much more nuanced, aspect in that.
Yeah, and just to your point of like the world progresses, technology progresses, I feel like just the banks have better risk controls and are better able, like 20 years ago, there might have been someone exist in one of those silos and start to add risk that they don't know about until it's too late. And these days it's like, no, you have risk limits at the end of every day and we're monitoring it. And we have technology that's monitoring it.
I'll say yes and no to that because, it's a perfect example is oil. Great intro. Oil going negative, right? Like everyone's Black-Scholes models are not set up to price options at a negative price. And, when I was leaving, it was a big big change that they were trying to get into to trade CSOs, which are commodity spread options. So it's the spread between a month. And those are tricky because those spreads, like in oil, can be minus 50 cents. They can be plus 50 cents. They can be minus $10. They can be plus $10. So trying to price those and create an option model, you really need a 2-factor model to have it. And you almost need a separate vol model just for those. So, it's tricky when you have that go negative, which is, again, like, is why a lot of people, when I forget who it was, but you saw that a lot of their option books just didn't price at negative oil. And, talking to even some of the banks, it's like when oil got to $20 and they started trading $5 puts, people were scrambling to try to do it. And it was actually a great lesson because all the option models that they had were zero bound, right? So you have your zero bound. So if I told you, okay, Jeff, price me a $5 put, you go, okay, that's worth 25 cents because the most I can lose is $5 because it's going to go zero and stops, right? And so people were pricing those up. If you go look at the price of that option, as soon as we went negative, the price of that option went about 10 or 20x because now all of a sudden people's models were like, oh crap, like it's not zero bound, it's negative, and then that makes sense. And
we should have all known that from interest rates, right? Like, hey,
exactly, right? Like people pay, and oil is an interesting commodity because you can't just turn it off. You can, but you're going to cause problems either in your well or your pipelines, or it's not like you can just go negative and keep flowing and keep pumping because eventually you're going to have space. If you're pouring a beer into a glass, when you hit the top, it's over. You got to stop pouring the beer. Otherwise, you're gonna have big problems. And so
that's where chugging comes in.
Yeah, exactly. Yeah. And so that was interesting to see kind of how the dynamic played out and who the mechanisms were that had to shut off when we went there. Which is why, if you look at the podcast a year ago, we would go negative, and I go, wow, this is one of the most bullish events that I think I've seen in oil. And where was I right in that? I was like, this is a great buying opportunity. This is the most bullish because supply just got shocked lower massively because we had to meet demand, which was down. And where I was wrong, I'd say, is I thought demand would be coming back stronger. And I think I underestimated the variants and the lockdowns and also how slow the rollout of the vaccine was. And also even now that the vaccine's been rolled out so far, I thought we would be almost zero restrictions right now. And I'm still shocked at how many cities globally are even still locked down or have failed to roll out faster. So, I thought, and I still think that the US when I look around, I still think that it's the roaring 20s. You've heard this analogy that, this summer is going to be a boom that we haven't seen in a long time. And I'm already seeing it in Jackson and travel. If you try to, if you look anywhere around, it's really ripping.
Now, a year later, was there anything that you didn't know at the time that's come out since, of like the dynamics of going on there? Or just give us,
I'm gonna try to toe the line on that without dipping too far into politics.
Yeah, or just give us what like technically in the oil markets happened now that we know all the facts, so to speak.
Yeah. That's a good question. So I think where I've been right is supply. Supply has not come back as strong as I thought back then. U.S. shale is still growing rather slow. We haven't come back. And also the willingness of OPEC to keep barrels off the market was something I expected, but I didn't think they would have this much discipline, and they've done a great job. So I'm very, very impressed with how they've kind of held that together. And even the Saudis doing the emergency 1 million barrel cut, they've never been that giving to the other players in OPEC specifically. So I thought that was kind of fascinating to see their dynamic of like, hey, we're going to do this. We're going to commit. Where I've been wrong, in trading, we always, the worst thing you can have is a manager who back trades you, who, a week later goes, well, why did you do that? You should have saw this, because you make the decision that you have, at point zero for that trade. Now at T plus 30, that trade might be totally different and you might hate it. And then you exit, but you have to make the decision at the time with the information you have. And so where I've been frustrated with COVID is, March 1st, 2020, people are still going out, everything's doing, we shut down through March. April, what do we look like? We're still in lockdown. May, okay, now that we know this, what did we do? June, July, et cetera. Every month should have been like a new evaluation of like, okay, if we got all this data on date right now, what do we do? But what happened is all the politicians, Republicans, everyone, they had already been so pot committed to their line of thinking from day one, whether it was a no mask, whether it was a mask, whether it was full lockdown, no lockdown, 50% capacity, no indoor dining, that they were too stubborn to change and pivot and look at the data and think about how they could go forward with it. So, where I've been frustrated is I feel like right now, given what we know, given the vaccine rollout, given everything, I feel like the world, at least the U.S., with how much we've vaccinated and how things are, should be close to 70, 80% back to normal. And instead, it's like, I think California just got indoor dining back, I think, a week or two ago. I don't even know.
Yeah, and kids just got back to school. Yeah.
Yeah, right. Kids just got back. So, and we knew I think in August, they came out and they said, kids are not carriers, kids are not this, kids are not that. But now it's still a function where the kids are not being punished, but they're not being allowed to live their life. And that's where I get frustrated, because that all drives demand. Now you're getting the message that kids need to be fully masked and they're not safe in school. So now people aren't traveling. They're not, the people, obviously, this is going to sound kind of bad, but if COVID affected only people under 5, this would be a lot different scenario for the entire United States.
Oh, yeah.
The world would have been shut down for years, because no one's willing to risk their kids. Exactly. And that's just the way of the world. And with 3 kids under 5, you want to see me go into bunker mode, in Wyoming with, guns and canned goods and bottled water. Like that's how that happens.
That's been out there. A lot of people have been saying, if the demographics had been switched, it would have been people would have taken it.
But I also think that you shouldn't, at a certain point, the kids just need to get back. We've already proven that we can't. It's like that. They've come out. They said, okay, kids under 5 are not affected. They're not carriers. They're not transmitters. Okay, great. Well, then why aren't they back in school? And then I think that comes back to both politicians and people making decisions that they have to stick with, and the message of it. Back to oil. I thought that we would be able to pivot every month. They'd look at the data, go, okay, cases are dropping, vaccines are rolling out. Okay, we're fully back. Travel's good. Go. And the world would be, much back, back to normal. So I expected
But you're also
us to
probably
be,
right. If I'm like Southwest Airlines, I'm like, don't flip flop month to month. I need like a right. It's almost better if you're over cautious and then flip it totally back on instead of month
I
to
mean,
month.
my wife and I joke
operation.
about this. Is like, I have friends, I have texts, I have everything. I think February 1st or 2nd, I'm telling my dad in San Francisco, I'm telling my mom, I'm telling everyone to like batten the hatches, stop going to school or stop going to class, to work,
Yeah.
stop commuting. I'm like, stay at home, work at home, just tell them you're not safe, tell them you're sick. I don't care, take a sabbatical. And we were very, very diehard masked, gloves, and I was the guy walking around in mid-February in gloves and a mask in Jackson.
Yeah.
People are looking at me like I'm insane, right?
We
But
drove down to Kentucky last Easter and camped. We're like, this is safe. We're just going to be in a tent on some land, but stopping for gas in Kentucky. I've got the goggles, gloves, mask, and these people are looking at me like I'd gotten off a spaceship. They're like,
right. But I was also the first person who, when June, July, when the data started turning and you're looking at what's actually transmitted, how it gets from A to B, where it goes, when I'm reading these research reports, I'm going, okay, now I'm less concerned about my kids. I'm less concerned about me. I'm less concerned about, I'm not scrubbing every item I bought at Whole Foods down and setting it in the garage for 2 days. Like we're not there anymore.
Yeah.
And, so I feel like, and that's where I feel like I got frustrated because I went from a 10 out of 10 to back to like a 6, okay, let's pull this in the middle. I'm still cautious. I am aware of it, but it's also like, and that's where I think demand should have been way higher for the last 6 months in oil. And that's what, I think when I looked at it in 2020, when we first got to that, I'm looking at the balances, I'm looking at forward demand, I'm looking at what I expect us to rebound to. I thought we could be closer to $80 or $90 this summer. And I still think it could happen. But that was kind of my initial target that I put out was I think this can be a problem. Like we could be in a world of hurt in terms of oil production and I still might be right.
Let me back that up for a second. So say I'm on a spaceship last year. I didn't know what happened in terms of oil going negative. Like what was that landscape in a quick paragraph? Just what happened exactly that caused it to go negative?
Yeah, so in March, when we went into full lockdown, global oil demand went down by, I believe, 24% now. So it went from about 92 million barrels to down to 70 or 73, I think, at the low. And oil production is very tricky it's a lot stickier, and you can throttle back some of it, but you can't just shut it down for the most part because it hurts the wells. Whether it's you have to build up pressure. It's just, there's a whole thing. There's 2 different ways of doing it. You can walk out, you send an engineer to the field, they turn the screw, it turns it from 10 barrels a day to 3. But below 3, it's going to be a problem because you have to cap it. There's a lot of issues with that. So what happened was we started filling up production. So again, back to the beer analogy, our beer just started to get close to the top, but the tap's still running. And, we had to figure out a way to jam that tap shut really quick. And it wasn't a sexy way of doing it. It was really just, like I said, oil went negative. We filled up oil storage pretty much almost entirely here in the United States. All of these companies cut their CapEx for the future by 50, 60%.
And what's our total storage in the U.S.? Do you know that?
Oh, man, I'm not sure.
But it's got to be like hundreds of millions.
Oh, yeah. I mean, Cushing itself has, I think they just built more. I think they're at 75, 80 million just in Cushing, Oklahoma. And there's tank farms on the Gulf Coast. I think it's a couple hundred million. But I'm not sure I've done it.
But is it the case, like, is this a 40-year problem in the making, right? Because the rest of the time in our history, it was just get it out of the ground as fast as possible and deliver it, right? So there's no
because there's
on-farm storage, as we'd call it in corn or soybeans, right?
Yes, yeah. There's a certain amount of storage that is like working, like 10 to 15% is working capacity storage, which is either, again, like tanks that are used for blending or ones that are used by like Valero or BP, which are tanks that are always in production, right? They're filling it, they're pulling it, they're filling it, they're pulling it. Yeah. So, there's a certain amount that are always being used. Yeah, so but it has been, yes, you're right. Like for the most part we have, but we also changed, I think 2 or 3 years ago where we started exporting oil. So that changed kind of the dynamic of Cushing and really moved the hub of oil. I mean, a lot of us in the oil industry think of like Cushing, Oklahoma, WTI as the hub. It's really Gulf Coast now.
Yeah.
Because the Gulf Coast is kind of the pricing mechanism because it's how we export. It's where most of our oil refining is. So, it's kind of ironic that Cushing, Oklahoma still has a say in it.
So it goes down 20 million barrels demand.
Yeah. Yeah.
And so where were we 6 months later? Now where are we 12 months later?
Yeah. So oil demand goes down 20 million barrels. And what happens is the response from the oil producers are to cut CapEx, which lowers the future oil production and how much we're going to be able to grow. And what's interesting about the U.S. production is shale wells produce about, I think it's 75 or 80% of the total oil in that well within the first 18 months.
Mm.
So, the decline rates just go like, they're just very steep.
Yeah.
So if after 18 months, you drill one well, you get 100 barrels a day. 18 months from now, you could be down to 10, 5. So it's an interesting thing where you have to keep drilling to grow. And a lot of the shale producers say that. If you look at their earnings reports, they say that we need to keep, hey, we improved production by 15% and we're going to be year on year flat oil production this year. And you're like, how you produce 200, you produce 200,000 barrels a day and you got better by 10 to 15% and you're flat. And it's like, okay, that's their decline rate. So they're losing that amount of oil. So you have to keep drilling to do it. And luckily, like I said, multi-pads and the pad drilling has changed and made it really more economical and efficient, but it's still something where they're losing oil every single year just by attrition.
Tell us what multi-pad is or pad drilling.
You're able to just kind of have like a number of different wells in one basically structure, and it can just move to each one and kind of go around. So it's less, rather than you're not just drilling all the way down and then stopping. You can kind of do it and connect them all together. So it's just a way of having it less equipment, more people, and doing it that way. So.
And then so where we've lost so now a year later, where are we based off?
Yeah. So that was kind of my big bull thesis was we went too hard to the other side. We filled up oil storage, we cut supply. And then again, back to kind of what I was talking about, demand and the politician stuff, I thought demand would flip back and we would come out of COVID. There would be a travel boom. There would be driving insanity. People would be traveling all over, and the supply side has a lag time to do it. So that's where I thought the demand would outpace it. So again, where have I been wrong? I'd say India going back into lockdown now. Brazil cases are still bad. London is still kind of in a middle, muddling around lockdown. And so a lot of these are attributing to it where we haven't come all the way back. And if we had come all the way back and if global oil production was up 5% overall for the last 6 months, we'd be at $100 oil. Because I have no doubt in mind. This would have been a really big, and I still think there's a chance with everything kind of going on in the Middle East and the timing of it all, that it still could happen. And I'm still bullish in the longer term.
So give me the numbers though. So from a year ago, where demand where is it up and down from last year?
We're still down small. I think we're high 80s right now, I think is the number. So we were at 92, 93, dropped down to 70, and I think we're back about 89. So it's close. And gasoline demand is coming back. Jet fuel's been obviously the one that's lagged the most.
Got it. That's what I was going to ask. So if we've removed jet fuel, what's down and what's up? So jet fuel's down.
Jet fuel's down. Gas, I think heating oil, which is diesel fuel, is relatively flat just because obviously people are buying more stuff on Amazon. Trucking's up, so the trucking industry has obviously had a boom, and the shipping container industry has done really well. Gasoline is, I think I saw a stat where it is all the way back. So we're still pretty close here in the United States. Like I said, the U.S. is doing its part, and I think you've seen that in stocks, in oil and even in, the rest, even in the S&P and whatever, all of our stock market, things are booming. The U.S. is going, and they're pretty committed to opening a lot of this stuff. So it's just curious how
storage basically got to 100% full.
It was pretty close. I think we're down about 50 now. So, yeah.
And what's kind of the long-term average?
I'd have to check. I think it's in the 35 to 40 range. Yeah, there's usually a lot of extra. Guess I should have updated my numbers.
Yeah, sorry, I'm hammering you
Yeah,
on the
thanks for
number.
that.
I just want to say, I'll throw the disclaimer out there. We're just looking for rough
Yeah,
estimates,
yeah, yeah.
not
I'm gonna get some tweets at you from oil things like, yeah, you were
not
off.
the
You're off pretty
actual
big in
number.
these.
So let's switch gears and come back to everything you're doing at Cayler, how those models work. Give us the quick elevator pitch.
Yeah, exactly. So we try to aggregate about 2,000 data points daily, looking at the energy market, refinery runs, oil production, demand forecasts, really anything that touches or move pipeline flows, anything that touches or moves oil or stuff we track and input into the models. And again, it spits out, buy sells on 6 different oil related products. About 70% of the VAR is related to relative value, and the other 30% is directional oil plays.
And all right, give us an example of some of the relative value trends.
Sure. So, great example on gasoline is we use gasoline cracks, which is essentially the profit that you would get if you took 1 barrel of oil, put it through an oil refinery, and then sold the gasoline that came out of that. And that would be your profit margin on that. So it's a really good barometer for the strength of gasoline, how much refineries are making or how little they're making. And subsequently, those prices will affect, you can change your refinery slate to either make a little bit more gasoline, a little bit more jet fuel, a little bit more, heating oil, and that'll affect it. So if you're making a ton of money on gasoline, but no money on jet fuel, which has kind of been the case for a year, or no money on diesel, you will make more. And so if you make more, then obviously supply is going to go up. It'll bring the price down a little bit. So there's kind of a, like I said, it's a wave where you ride a whack one side and you try to ride the other side. So.
And you can trade the crack spread itself, or you have to buy crude and sell gas, or vice versa?
No, there's single entity trades on all the platforms. So.
And then crack comes from, that's like the chemical process at the refinery, right? That they're heating it up.
Exactly. Hydrocracker, cracking of carbons, essentially.
Yeah. And so I don't know, you're not a chemist, right? So, but it's like
pretty familiar.
Well, tell me how it works. So the highest octane is like the top of the heat chain, or how does that work?
So octane's a tricky one because that's more gas focused just on gasoline.
All right, sorry.
But yeah, so
octane.
So if you take a barrel of oil, you put it into a refinery, it goes into the hydrocracker, right? That's usually the big still that you see. It's a huge, like if you drive past a refinery, you'll see one giant tall one. And what that is, that's different levels of it in it. And you put the barrel of oil in, and as it heats up, the lighter ones go to the top, and then it kind of filters down. So you'll have, like jet fuel at the top, or, some of the really, really light ends like naphtha. And then at the bottom will be the sludge. So they think of that as like, fuel oil or, heavy resid, I think is what it trades as. And then out of those get filtered out and go to each different, there's a lot of different processes. So that are, there's an FCC.
Right, then you'll blend it with ethanol and get something, or you'll blend it with something.
I mean, it's kind of interesting because gasoline is one of the only products that's not one product. Like you'll get gasoline out of that one, but then you blend it up with, whether it's ethanol or you blend it up with diluent. There's all these different ways to create different types of gasoline. And the United States is kind of a weird scenario because California has their own one called CARBOB, whereas everyone else trades RBOB. And has
I never even heard of CARBOB. I like it.
Yeah, and also it has to do with the weather. So you guys, I think up in the Northeast, you guys have, when it's cold weather, you have winter grade and summer grade gasoline, and you probably don't even notice it, but there's different prices associated with it. You probably feel a little bit, and it's a very seasonal product in that regard too.
And then talk to me a little bit about the refinery, right? If they're buying, I think Saudi oil, right, and even normal Texas oil used to be like the cleanest and purest, and then some of the shale stuff or Canadian sludge, like is heavier.
Yeah, so they have different API contents, right? Like the Saudis have, whether it's sour or they do have regular, light sweet crude. So like WTI is obviously a light sweet crude. So, low sulfur.
That's the easiest to refine?
Not necessarily, because each refiner, so what happened is we had kind of a resurgence of heavy and medium sour crude in the Gulf Coast. So all these refiners in the Gulf Coast that came around in the 90s, they built them to accept that medium sour crude. And what's interesting about shale is it's super, super light. So it's almost causing problems in those because it's so light. But what's interesting is you can take a lot of that shale one that's really light, you can put it through an FCC and you end up with almost just gasoline without doing the whole refining process. So what you saw is a lot of these FCCs just kind of pop up in hydrocrackers and all these kind of teapot refineries around the US to accept that because they can put condensate into that and have it split out and it's good quality already.
What's an FCC?
Fluid catalytic converter.
Got it.
And
all right, sorry. So I got us off topic there. So back to Cayler.
No, it's a good question. So the short version is if every barrel that you put into every barrel that you put into an oil refinery have a specific slate that it creates, and each refiner knows that. So they go, okay, if I buy one barrel of Bakken oil, it's going to produce me, 1/3 gasoline, 2/3 this, 1/3 this, 1/10. Here we go. Okay, go from there. And then the other one will be, okay, if I take that and I blend it with Mars, which is more of a medium sour, okay, that's what I get out. And so each one, it's always like that's all the refinery engineers do is they sit there and they tinker with it and they look at it and they try to optimize it on what they need to produce and how to go through it.
And so each of those inputs are part of your model of like, hey, I need to know what each of these inputs are to know what the proper profitability of a
yes and no. That's I don't get into refining engineering and the slate of it. I just try to forecast more what's one barrel going into it versus one coming out.
Got it. And in theory,
that's a little too granular. To be honest, that's something that I don't even. If I gave me all the research of JP Morgan, it'd be very, very hard to track, even just from that standpoint. That's a very close to the vest kind of refining issues.
Because that's kind of their profit model.
Yeah,
right?
that's their yeah. They don't want to know that they make more money doing Eagle Ford. I mean, you can guess somewhat. The slates are pretty well known. It's just chemistry, right? But when you look at it, you don't want to. They try to hide some of that. Yes.
And so all the inputs come out, then it gives you a buy or sell, either on the relative value and on the directional stuff?
Yeah, exactly. That's right.
And then is there discretion there? Like, okay, I'm taking it, I'm not taking it?
No, there is no discretion on it. So the only human input that I have is sometimes I will manually input refinery turnarounds or, whether they're going down or how it's going. And a lot of times that's just because it's in the industry, but it's not published yet. So you might hear that, hey, Shell's going to move forward their turnarounds and it'll change it, change forecasts for how much oil we expect to be used, how much product's coming out of it. So you think of like that. Turnarounds just for maintenance. It's another word for maintenance. They call it turnaround.
They shut it down. They got to clean out the pipe, so to speak, and then turn it back on.
Yeah, exactly. And it's always a process, and you have to plan because you have to buy parts, you have to shut down, you have to, you think about it, you're selling, the refiners have to do two things. They're buying the oil and they're selling the product. So you have to stop doing both at the same time. Otherwise, you'll just end up holding the bag on one or the others.
Yeah. Okay, so all this comes into the model. It shoots out these buys and sells. So you said 30% is directional.
Yeah.
And that's kind of long term or short term. What does that look like in terms of your forecast?
Yeah, the average holding period is about 7 days. And it's kind of what I said earlier, how, you have the decision you make at that time, and sometimes it changes and sometimes it doesn't. So, I'd say they're longer term models, but I will say that they change quite frequently in the, 7 to 10 holding period.
And then so I remember last year you were saying everything was so volatile, you're going out into D's 20 futures.
Yeah.
So even though you're trading the D's 20, you're still only looking 7 to 30 days or something?
Yeah, exactly. There's enough liquidity out that far that it's not a big deal, especially in the oil market. So, we target an annualized volatility of between 15 and 20%. And when I think March happened in April, even though we were positive volatility, we were still running at about 36% annualized vol, which was just too high and too much. So we rolled out from April at the time to December, and it brought it back down, kind of to the low 20s. But
what else on the model you want to tell us? And you, I'll ask you. And you changed. I can't remember when that was. It was right around March of last year, right? Like you made it more systematic, or was that back in 19?
Yeah, that was in 19. I started, I initially was going to launch and trade an option portfolio as well. Obviously doing SMA with doing managed accounts with option portfolio is very tricky. And, and I ran into capacity constraints and size constraints with that. So that kind of caused me to reevaluate how I should be approaching this, and just launching a pure systematic strategy was the right call.
Yeah, I was going to say, you've been happy with that switch? I think
Absolutely. I think 2019 we were up 7%. I think last
yeah, we
year.
can't talk performance, but you've been happy with
Oh. Yeah, I'm happy with it.
And then how do you always write
No down years yet. I will jinx.
Right.
Knock on wood.
How do you think about it? Like, you're a small one-man shop. You have some outside vendors and help and whatnot, but like, how do you compete with like Mercuria, who we mentioned, and Vital, and all these big boys who are essentially also looking to make money? Is there enough room for both of you, or how do you view that?
Yeah, it's a good question. I think there's room for everyone. It's kind of one of those things where there's a million ways to skin a cat. And you talk about the Vitals and the Mercurias, and everyone who's trading that, they have guys whose only job is to do gasoline blending, and that's all they're trading. So I think I'm a little bit different in that I look at the whole picture. I'm trading gasoline cracks, I'm trading heating oil cracks. We have WTI Brent differential. There's an option component overlay in it. So it's kind of a breadth versus depth thing where they can be very, very siloed and very nuanced because they're trading such large size and they have so much support. But trying to find a fund manager who captures all that, I think, is a little tricky, and that's been something that I'm proud of.
And then we'll compare yourself then to like Andy Hall or Andoran, who we mentioned before, right? Who are making huge macro months-long bets on prices.
Yeah, I think that's also I think that can spin two ways. Last year, obviously, Andoran had a great year, and there's no line that. That's just facts. And I think what's interesting though is I look at my returns from last year, and I think they were almost evenly split 50-50 between relative value and directional. So, my question is, was it, I don't know his returns, I don't know his breakdown, but was it, he got one trade right and he got it really right? Or was it more of a kind of, spread out return profile that, hey, the models are capturing 6 different aspects of the energy space and kind of nailing it, because there's, you only have to be right once if you want to get big returns like that. But I'm curious how the breakdown would look like. Was it 100%?
We'll try and get him on the pod and ask him.
Yeah.
Because I've read stuff. It seems like he just swings for the fences, right? Like, I think it's going here and I'm loading up.
To be honest, if you look at his returns, his returns were great last year, but I think his annualized volatility is somewhere in the 40-45% range. And if you look at his drawdowns, he's had multiple 50% drawdowns. I lose clients at 10, and I'm like, Apple stock has gone down 10%, 30 times in the last 10 years. You're probably still holding that. So it's
and then you just mentioned option overlays. What does that look like?
Yeah, I run it is a option model that essentially says what is the odds that we are at certain X% at certain prices in the future. So, a good example would be in 3 months, we're at $62 in the front of oil. What are the chances we're at $80? And then I take what my models are saying is that percentage, and I apply it to what the option models are saying in the volatility market. So if the option models, let's say the market is saying there's a 12% chance in the option models, but my models are saying, hey, supply demand forecasted for 3 months, wow, this is 50%. We'll enter into essentially what's called an at expiry digital option, where it says at 3 months, if it's above this, we get this amount of payday, and can go from there. So,
and you do those? They're cheaper because you can't get out beforehand?
Well, you can get out beforehand, but typically the way that I like to trade that is because it was the only way I could quantify it in terms of the models and giving a percentage. So it was really the only apples to apples that I could create at the time.
They're basically pricing it exactly as a percentage instead of like you having to model.
Yes, exactly.
Cool. So then I like that. And that's in your directional bucket then?
Yes.
Yeah. And then the other directional is, so you'll go long or short oil. What else? Gasoline?
No, just oil. Yeah.
Just
So
oil.
oil is the only directional one that we will take long short on. Like there will be times where two models will kind of offset each other, if that makes sense. So if I'm long a gasoline crack, right? I'm long gasoline and I'm short oil. But then if the oil market comes in and says we're long oil directional, those two oil will just offset and I'm just long
And then
gasoline.
got
But
it.
in my mind, I look at this as that's two model
Trade.
trades. That's not just I'm long gasoline.
Yeah. I like it. And then vice versa, if they kind of could double up at some point, then it's kind of a confirmation bias, right?
Yeah, exactly.
At least on the oil side. So you're doing WTI and Brent or just WTI?
Both.
Correct.
Yeah. Yes, that's
Both.
correct. So it'll look at the models will look at each one independently. The WTI one is more focused on the U.S. flows, pipeline flows, Cushing storage, Gulf Coast economics, and also the oil refineries here. The Brent model is more of a macro model, looks at more OPEC kind of world flows that we've had, and I think that's been not the biggest issue, but I'd say it's caused problems in terms of my overall bullishness versus the models, because the Brent model has kind of been muddling around between flat, long, short, and the WTI model has been fairly bullish for the last couple months. And I think we've seen, like I said, you've seen that in the stock market, you've seen it in the dichotomy, but it's one of those aspects where I put out notes and I tell people I'm bullish, and then the models are bullish US but bearish Brent, and they're kind of going up together, and one's kind of leading the other, and it's so it's been frustrating in that regard.
Where's Brent right now? Has it lagged because of the kind of global?
No, I mean we've kind of gone up, but the models have not caught the move higher.
Right, but you think what's going on in India and Europe, right? The rest of the world, you'd think Brent maybe would show some of that demand.
Yeah, that's exactly right. And that's been, like I said, it's been a frustrating aspect, and I get notes about that from clients.
But there's also an ARB there, right? So it can't get too far dislocated.
That's right. And so that's why it's been kind of, the WTI strength has been in the US has been kind of pushing higher, especially with the, kind of backdrop of inflation, money into the system. It's, kind of, we've had a huge inflows in the retail space. So yeah, like I said, like it's been, I'd say the last 6 months have been frustrating just from that standpoint, where I've been bullish, but the returns haven't been there in the oil program, just from a standpoint of, like I said, WTI has been kind of long and Brent's been kind of muddling. So.
And what do you think, right? Like Saudis tried to launch their own futures contract to kind of get a little more granularity on the demand right out of there.
I think that was more of a money grab and kind of a way to have them, and that's kind of like with China, like when China launched their curve, it was just an easier way for them to buy.
Yeah.
It's just an easier way for them to buy oil and kind of be in the game. So I'm sure they're tired of paying in dollars too. So
yeah. But in what you see and who you talk to, like traders aren't really moving into those markets to.
No, it's a nice basis market to be able to trade and have it, but people aren't, No.
Yeah, so you just use it kind of to hedge your basis.
Yeah, exactly.
And then mention China. So you're working with RCM, do some models on China. What's that look like?
Yeah, so we trade 13 models. It's more of a macro portfolio, and I was actually able to, one of kind of the last hurdles that I use in my Cayler Capital US-based models is term structure, and there's an algorithm that I created that looks at term structure in kind of the final one. And I was curious if it would, when it was first approached by RCM, I thought, I could wonder if this algorithm, the last one, which doesn't look at any fundamental data, it's really just price data, would work on those. And it's been doing great. So we trade 13 models over there, more of a macro portfolio, kind of ranging from glass and chemicals to financial instruments to metals. So it's been really fascinating, and it's doing really well.
And then what are your thoughts just on the crude curve? I don't even know what it looks like right now, but is it, back in March, right? It was super steep.
Yeah, I think we're going to end up in a scenario. Right now we're still, let's see, December 21 is about $2.20 below where we are right now in the front.
Your quote screen is very high. You keep
It's
looking way up.
it's the double screen. Yeah.
Sorry, so
Um,
these 21s where? How much higher?
about $2 lower. So we're back. So right now it's telling me that the demand here in the front, we need it more than we do to store it, right? Because people aren't
$2
being
lower.
incentivized to store oil. I think that's probably about right, and it might even expand higher as the summer driving season picks up. We're about to hit. I think we have about 2 to 3 weeks, and then I'd anticipate we'll know by the 4th of July whether I'm right or wrong. Let's put it that way,
Yeah.
because we're either going to be sitting at $75 in the front, or it's going to be kind of just right around here and buttling, and then that will be something that'll tell me that, hey, might be lower for longer, and we're right there.
Switching gears for a minute, like a lot of renewed interest in inflation fears and commodities as an inflation hedge. I don't even think most people who think that realize that what they're really saying is oil as an inflation hedge, right? With most of the commodity indices made up of mostly oil. So what are your thoughts on that? Is it a good inflation?
My thoughts are oil is probably the worst inflation hedge. If you look at the other futures that's come out, I'd argue lumber has been a bigger barometer for me of what we're seeing. I'd look at the softs. I think all corns and grains are much better. When I look at inflation in my personal life, I don't know about you, but I feel it more at the supermarket and more in rents and home prices than I do in whenever I go to the gas. So, it's interesting dynamic,
It's
especially
private
now that people,
school and property taxes for me, but yeah,
yeah,
not
right,
oil.
exactly. Yeah.
Interesting. So right? But in theory, then that's going to remove, well, what are your thoughts on just macro levels that it's going to drive some demand, some buying pressure, right? If we go back
absolutely. I mean, there's some there. We saw, I think I'm trying to think, like in February, and look at when it was, we had huge, strong buying in oil just from a standpoint of every single person was putting out inflation pieces. Goldman Sachs, Bank of America, Merrill Lynch, every single person was, we're in inflation. It's going to be, buy oil, buy oil, buy oil. And you saw it in January and February, where we went from about 48 to 62. So we went up, about $14 in that. And I think a lot of that was driven. I mean, a lot of it was Saudis too, but a lot of it was also driven by the macro push of inflation. I think it went a little too high. We got up to about 68 in the front in oil and WTI in March, and that's kind of a shoulder month. Demand slumps because no one's really driving. It's getting warmer, so you don't need heating oil. So it's surprising that March was kind of the high of the. So I just thought it got a little bit too far ahead of itself. So I think it's kind of normal that we're hovering between 60 and 65 in oil for the next 6 weeks, and then I would expect something higher.
How is heating oil still a thing? Do you know anyone that uses heating oil?
Everyone says heating oil is just it's diesel fuel. So it's it's
But
kind of
even
fascinating.
diesel, who's using diesel to heat their homes? Or is that from the
what's interesting about that is you could take heating oil from your home and put it in your car, in your diesel car. So they actually are forced to dye it a certain color so that there's a differential between there. But for the most part, you could take they're essentially 1-to-1 because it's low sulfur heat distillate now. So kind of interesting.
Historically, that's been like Northeast, right? That kind of uses heating oil.
It's Northeast. But again, like it's diesel fuel. So like when you think about like trucking, you think about everything that's kind of gone on over the last year and a half and how much trucking, and you forget that most of the world is still diesel fuel, and especially ULSD. So
but to produce electricity, we're saying, to heat homes?
No, to drive. Like if you go over, you go to Europe, it's most people drive. Most people drive diesel still. The U.S. is kind of the weird one, but.
And then, what are your thoughts on? Well, a few things while we're kind of talking about the whole world here. So, alternative energy, wind, solar, everything's that going to dent demand?
I mean, I think I'll stay on on that note. I think the electric car revolution that we're seeing will, at a certain point, we will end up in a scenario where I don't want to say oil is the new natural gas, but if you look at natural gas, in 2007 and 8, it was $10, $12, and now it's a byproduct, right? And it still is tradable. I still plenty of hedge funds. There's still plenty of risk to go around. It's just at a lower base, and I think that could be the scenario for oil, down the road. But I'm talking 10, 15, 20 years. The adoption rate of these is very, very slow.
Does that worry you from like a career business standpoint, or like whatever? No, even if it's in a $5 to $25 range, it's still tradable.
Yeah, it's still totally fine. Like I said, like if you look at natural gas, this is a blueprint, right? Like we had massive supply finds, the supply demand imbalance shifted. We go to $3. We've been at what, $3 for 6 years now.
Yeah.
I can name off the top of my head a couple of different billion-dollar hedge funds that have either started or are still around or still trading. The natural gas desks are still some of the largest at the banks. So it's needed, and I mean, I don't think it will be there. I do think that it was interesting that we have kind of crossed the threshold of solar, where for the first time solar is cheaper to do. So you will see more adoption of that. And I think like the micro. What was that?
Sorry, real quick. My wife's uncle's house. We were there a couple months ago in Miami, and he's like, "You want to see my new Tesla?" I'm like, "Sure." And we like go out the back into his garden, and I'm like, "You have a car back here?" And around his side of his house, he had the
roof,
like battery packs on the side of the house, and he's got solar all on the roof.
Yeah,
it's storing the solar, right? And he pulls it up on his app, and he's showing me he's putting it back into the grid. So it was kind of cool. I'd never seen that live.
Yeah, I think that'll be. I mean, our electricity grid as a whole is garbage, so it'll be interesting to see how these kind of startups and things come in and do it and take it. But I think oil is here to stay.
My next question of your thoughts on the whole Texas debacle, and I know you don't trade power per se, but you're tangential to it.
I mean, yeah, it was bad. These things are tricky, right? Because you have a lot of them are spot energy markets. The people can trade them, and I mean, it's one of those things where it's hard because our grids aren't good, and when freak storms like that happen, you forget that people are still going to need it and they're going to pay it, and it's an essential commodity, essentially. So.
And I've seen some reports that net over like 5 years, they've still paid less than the national average.
Yeah, for sure. And I mean, that's
getting $11,000 bills or whatever.
Yeah, that's where like I don't feel that bad as those the people who did that, they probably didn't know the risks associated with it, which isn't fair because they didn't know that they get the spot rate of prices, which to be honest can spike, like you said, you saw it spike incredibly high, and now it's back to lows, and
it went from like $4,000 to $4,000 or something.
Yeah, but people forget that in the commodity prices, like when people need something, there's no price they won't pay.
Especially electricity, right? Like just imagine what you do if you're somewhere and you need to like charge your phone, right?
There's like certain things like electricity, water, like you're going to pay whatever it is that you need to do that for that time at that time if you need it. And gasoline's another one like that, like, oh, gasoline's $7. No, but it's like if there's no oil or no gasoline, you can go to 20, you can go to 30, who cares? Like there's no number for it. So
yeah, which I've been thinking, why I don't know how the power market works exactly. I'm trying to get some power guys on here to talk through it, but why not spend 1% a year on calls? Right? It seems like once a year it spikes crazy like that.
Yeah, I don't know how that would work in terms of, I don't know if the option prices will go that far out. But you could. I recall I think it's shorter. I think a lot of the power contracts are like very short.
Or even a day. I think some of them it's like daily.
Yeah. I'm trying to remember. I interned on the power desk at JP Morgan for it.
I was going to say, you ever been tempted by the dark side there and be like, let's forget this 20% vol. Let's go for 150.
Yeah, I can't even. I'm trying to remember like how they did it and how it was. But some of those guys had monster years.
My next one, we touched on a little bit of the shale economics. So I think we talked back last March of like the banks, like the whole ecosystem's kind of shifted and dried up of like, even though we have super easy money right now, the people aren't as willing to lend to drillers. So that's still the case.
So you're starting to see it expand a little bit. There's actually been some distressed credit funds, which are only focused on energy lending, which makes sense because, there's a lot of opportunity. They can charge a higher interest rate for it, for the revolvers and the loans credit that you're doing. So I do think that it's loosened a little bit, but when I look at the CapEx, I think this quarter will be a big tell because this is the first time, we've been above 60, right? And looks like we've been here for a couple of weeks. So I'm curious if when they start releasing earnings, if they'll come out and they say, hey, we revised our CapEx budget XYZ, we're gonna go for this in 21 and try to capture some of it. So.
And do you know off the top of your head what their like break evens are? Is it 60? Is it?
Oh, it's below here. We're definitely profitable here for sure.
Okay.
I think most of them are between 40 and 50, 40 and 55. So somewhere in that range.
Got it.
Yeah,
So,
it's interesting. Like I was talking with someone else, and this might be the first year where all of these shale companies are dividend companies because they're going to have so much cash coming to them because they're not spending it. Typically it's drill, collect, reinvest, drill, collect, reinvest. And this is the first time where they're just drilling and collecting, and they're going to amass quite a stockpile of cash over the next 6 to 9 months.
And even some of them may have not drilled even, right?
That's right. Yeah. So that's what I'm saying. They don't have any expenses. They cut workforce, they cut everything. So it'll be interesting to see kind of how it all trickles down.
But also a lot of them were part of this Russell outperforming the NASDAQ for a bit. There was a lot of the energy.
True. Yeah. They've definitely lagged on the way up here. So.
Let's go through quickly your favorites. Hopefully you've read up on your Star Wars characters since last time. Doubtful.
Oh no.
So favorite ski spot or thing to do in Jackson outside of the actual mountain?
Fly fishing.
Fly fishing. Nice.
Yeah.
You go way out, or there's drivable.
Wade. Yeah, we just wade out. You can actually go on they open up the elk refuge right here, which is a really cool creek. You get to walk out, nothing around. Tetons right there. The Snake River obviously is the main one, which runs straight through it. And any place you can pull over is great fly fishing. There's a million creeks around.
Right. I meant you're not going like my brother did something. You went for 2 days on a horse somewhere in Idaho or something.
Definitely not. No.
Yeah.
There's no disappearing for 2 days with 3 kids under 5. Hey, honey, I'm going fishing for a week.
And your business, right? Yeah, the models will run themselves, keep the kids busy.
Yeah.
And what do you get? Mostly brown trout, rainbow trout? They got anything?
All kinds of trout. Yeah, we have cutthroat. We have rainbow. We have a lot of trout.
Love it. Jackson, I think everyone's like out there eating elk and stuff. You got a favorite like game type of meat?
I'm not a big fan of the game ones. I've tried elk and bison, but I prefer just standard steaks. The steaks out here are so good. I think I saw something, and it's like all the restaurants in town, I think the farthest away they buy their steak is like 50 miles or something like that. So it's pretty crazy.
Pick one out. When we get there, you got a favorite steak place?
Snake River Grill is the biggest, and it's really good.
It sounds good. That's a good name.
Yeah.
Favorite commodity investing book, or commodity oil book? Any of those?
Man, there's a bunch. Let's see. One that I really enjoyed, which is kind of an obscure one, is called Satan's Bushel.
Sadie's Bushel?
Satan's Bushel. Yeah. And it's about kind of like the last. It's an old school commodity one about how the kind of the last. It's like as soon as you produce one more barrel than you need, and so there's a buyer, it can crash the whole price. So they call that one like Satan's Bushel, essentially. But I really enjoyed that one, and kind of gave me a good understanding of the physical markets and how things can kind of move and go about it.
And I think we've talked before. One of my favorite books all time was The Prize, the Daniel Yerden.
Oh yeah, Yerden.
Just going into the history of all this stuff I'd never known about, like some British guy who got 50 cents on every barrel out of like basically the Middle East for a long time. And
it's crazy. I'm trying to think.
Shell is Shell because they basically started in all the Caribbean islands and whatnot.
Yeah, I think there was one on. There was one I read. I think it was about Mark Rich. And he's just a fascinating guy to me, kind of, that I really enjoy, just from a standpoint of trading and understanding like what he was looking at in the oil markets. I can't remember the name of it, but it was about Mark Rich.
We'll find that one. And then favorite Star Wars character?
Baby Yoda.
Baby Yoda.
Big
nice.
Mandalorian.
He's got a new one. Yeah, my family's pumped for all the new spin-offs that they're pulling out of that. I don't know how they're going to. Mandalorian might take a dip down with no more Baby Yoda, but
I know they're going to have to do something. So
for sure, in like the 4th or 5th episode, they're going to bring him in for a quick snippet.
Definitely.
All right, Brent, it's been fun. We'll for sure plan up a in-person meet in Jackson sometime
Sounds
next week
good.
when there's snow on the ground.
I should come out in the summer. It's better.
I know. We did the summer last year. We didn't make it. We made it to Devil's Tower in Wyoming, but not over.
Almost.
Yeah. All right, buddy. It's been fun. We'll talk to you soon.
Thanks again.
Thank you.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.